to where you think we can go, you were pretty right as to where you thought we would be, right? 47.50 was your target for the end of this year. We're at 46, we'll call it. You said mega cap was going to lead the way. In fact, it has. Why do you think things have gone right for you and investors and bulls for the most part, especially lately?
I think people were fooled by the yield curve at the start of this year, thinking we'd have a hard landing, and they didn't want to fight a Fed, but they're forgetting the Fed was fighting an inflation war, not a business cycle. So our bet was inflation would be softer, you'd avoid a hard landing, and then we've seen the Fed kind of take its foot off the neck of monetary policy. So I think it was economists were too bearish, and the technical picture turned positive very quickly. It was a triumph of technicians.
Yeah, it's not over yet, right?
No.
And there are those who still say that the cycle's going to end because of what the Fed has already done. We just haven't seen it yet. You've heard that. How do you respond to that?
I think people should study market internal structure. We've seen a huge turnaround in cyclical stocks. The banks are turning, the regional banks are turning up, small caps are leading. This is not end of cycle market behavior. This is early cycle expansion reaccelerating.
What if it's just a late year, run as fast as you can, catch up to what you missed, a lot of money has come in and it's just chasing everything to the end of the year as rates have come down?
Well, if we thought this was a head fake, and I think if this is 98, we can run another 7% from today.
To when?
To year end. But
this year end?
Well, I think 4,800 is more reasonable, but I think that if it was a head fake, we'd see credit calling baloney, and we'd see spreads widen or high yield falling. But what's happened is spreads have rallied, high yields rallied. It's actually a improving liquidity rally while investors took $240 billion out of stocks this year.
So you're a believer in the broadening of the move, and you think it carries beyond the calendar turn?
Yeah, because now as we get into next year, we'll have an FOMC decision, but I think it's going to show the Fed is no longer fighting an inflation war, but really shifting towards managing the business cycle. Huge change. I think interest rates could make a huge move lower. Mark Newton, our technician, thinks it could be 3.5%, 3.2%. And that would take mortgage rates down to 5 or under 5%. We know that would help the economy, and I think there's a lot of pent-up demand for CapEx. So I'd say that stocks could do very well next year.
Well, you must if you think we're going to get to your target for 2024 S&P is 5,200.
Yes.
What gets us there?
Well, it's earnings recovery. So we think earnings hit 265 by 2025. That's 2 years of like 9% growth. And you put a 20 PE. A 20 PE has happened 50% of the time when the 10 years between 4 and 5%. So it's the most common PE to apply, and that would be 5,200. But I think that's conservative because 265 is 5% of it's coming from cash, right? So there's like 3% organic growth. I mean, cash earnings is 5% growth right now per year.
I hear bears say earnings aren't going to be as good because inflation is not going to be as good for earnings. And that's going to be a negative, and that's why the market's overvalued, and people like you at $260 are just way too optimistic on where earnings are going to be.
Well, I think people should study the PPI. Like 4 or 5 sectors are correlated to PPI, like materials, energy, meaning as inflation falls, they make less money, but tech and industrials have almost no correlation to inflation. And then financials are positively correlated. So I think you have more groups that could actually have better earnings power into next year, and especially if caution comes off companies. CapEx, there's a lot of pent-up demand in CapEx. 5 out of 10 groups actually sort of cut CapEx as a percentage of revenues last year. So you have a CapEx opportunity, you have a home recovery opportunity, and you have interest rates falling. It's hard to say stocks should fall next year.
So the market thinks the Fed's going to cut first in March, 3 meetings from now. Is that what you think?
I mean, to me, that intuitively seems aggressive, but what's going to matter more is what the bond market starts to price. And I think the two-year is telling us the Fed does have to cut meaningfully next year, because if they don't cut and inflation weakens, the level of real Fed funds is associated with a hard landing. Like the Fed, if they're trying to manage the business cycle, would be cutting rates.
Yeah, but you think it could be a little aggressive in terms of March. Do you need the Fed to be somewhat aggressive in cutting to get to your 5,200?
We just need the market to get comfortable with two things: that the curve can stay inverted, meaning the 10-year could actually go to 2.5 and the Fed's still at 4. And the second is that stocks and bonds don't have to be positively correlated. So yields could go up and stocks could rise. So I think that there's some protection or buffer against if the Fed doesn't cut rates.
How much do you need cash to come in from money markets that's been sitting in safety, and now it goes towards risk assets because rates have come down and you get better yield out of the equity market?
Yeah, I mean, Scott, this year if someone bought FANG, they'd be up 85%. That's 15 years of money market cash. If they buy small caps next year and small caps are at 50, that's 10 years. So I do think the $240 billion that left is coming back in. But hedge funds also have very light positioning in equities. I mean, I don't know if you saw that there's almost a 5-year low in hedge fund positioning in financials, and financials really should be where things turn next year. You
think financials are going to be one of the leaderships? What about small caps? Because that's where a lot of the conversation has been of late, this awakening that the Russell has had.
Yes.
There's still a lot of non-believers.
Yes. I think there's the callus in place. We've had 12 years of underperformance. The price to book of small caps to the large caps is exactly where it was in '99, which was the start of a 12-year bull run. Banks are a huge weight in small caps. We know falling rates helps asset quality, so regional banks should rally. That should pull up small caps. It's clearly under-owned, and they benefit from inflows. And then, of course, I think large cap banks are really good plays on a CapEx cycle. So to me, it's easy to see the 20-30% kind of moves in those groups. I mean, small caps maybe 50. Whereas it's harder to say FANG can do 50 next year.
The other big call that you're making today, despite revealing your target at 5,200, is suggesting that mega caps, tech, not going to lead next year.
That's right.
Why?
I think, it's that I think the earnings growth they produce doesn't look as special if the PMIs are turning up. If the ISM turns up, S&P earnings are going to grow, 15, 20%. And then in terms of multiple expansion, I think people are going to be more willing to fade a FANG multiple expansion, whereas they'll buy a financials multiple expansion.
So I want to be clear. So you think there's going to be a rotation out of mega cap into some of these quote unquote unloved areas?
Yes. I mean, FANG is still a number 3 pick, which means it outperforms. But if someone's saying where will they get the best risk reward, I think it's clearly financials or industrials.
When you say that FANG still outperforms, the word you use, put some context to that. What does that mean?
Well, let's say S&P's up 12 to 15 next year. FANG will be maybe a little bit better, whereas financials probably can be up 30, and industrials can be up 25, and small caps can be up 50.
So we're going to really have that significant of a mean reversion trade, so to speak.
Yeah, I think it's consistent. If you look at like the history of a stock like Amazon, they have great, a step-up year, and then they consolidate.
Wow. Let's expand the conversation. Bring in CNBC contributor Joe Terranova of Virtus and Ayako Yoshioka of Wealth Enhancement Group. It's great to have everybody with us. Aya, I go to you first. Does Tom Lee make a lot of sense or not?
Hi. Yes, absolutely. 2023 has really been defined by a very narrow market. And so it makes a lot of sense that going into 2024, that we would see a broadening out of the market, especially if the economic data comes in, relatively benign, neither too hot or too cold.
So you do think we're going to have a broadening? You agree with Tom that we're going to have these lagging sectors are going to be the leaders, that tech can still do well, it just doesn't have to carry all of the weight like it did this year?
Absolutely. I mean, I think if the economy continues to stay relatively strong, some of the, names in the lower half of the S&P 500 have a lot of room to, have the multiple expansion, as well as perhaps some upside surprises to their earnings growth as people start to anticipate a recovery from the slowdown in 2025.
Joe, is Tom too optimistic or not?
Well, first of all, Tom's been incredibly accurate so far in 2023, so congratulations for that. I run an equally weighted strategy, so I'm excited to hear your comments for 2024 because that obviously means the strategy is going to be favored. But there's 3 points I think we need to hit on. First of all, when you look at the market right now and you talk to advisors who have clients sitting in cash, the first thing that they will tell you is they expect the economy to slow And the cash that Scott cites going into risk assets, those risk assets aren't equities. They want to put those assets into credit because they believe they're also going to get price appreciation. How would you respond to that?
I'm a fan of bonds. High yield returns 80% of stocks with less volatility. But we know that if bonds rally next year, that actually has an expansionary effect on PE. So to the extent people decide to allocate to bonds and spreads have a huge rally, it actually means there's upside to the S&P just because the multiple now has more room to expand.
So Joe, so Tom says 20 times earnings makes sense. Earnings at 260 makes sense. Is that too aggressive or not?
He's too aggressive with financials. I'm worried about financials. Let me explain why.
What about the overall? Give me the view. He says 5,200 on the S&P. Follow me. Stay with me.
No, I'm staying with you, Scott. You know me a long time. I don't do S&P price targets. I do the environment. I've never sat here and said,
okay,
we're going to 5,200.
Okay. All right.
The environment is a favorable one.
Let me rephrase it into a way that we can agree to have a conversation about this. Is the environment going to be optimistic enough?
Absolutely.
That the S&P can get to 5,200?
I don't know the answer to that. I don't think anyone knows the answer to that. I'm sorry, Tom. I don't think anyone knows.
Can we have double-digit returns next year?
Yes, absolutely, you can.
Okay. Aya, what about you? What do you think?
I think we could have double-digit returns too, but I think the setup is very different going into 2024 than what we had in 2022. We had a lot of upside surprises this year in 2023, and I think we could have some jolts depending upon how the data really pans out and how earnings really pan out in 2024.
Well, I mean, for earnings to get to $260, things have to go really right, don't they? I mean, how perfect, I hate to use that word, but in some sense, things need to be perfect. That inflation needs to come down to target. The Fed definitively needs to be done, if not cutting. The business cycle needs to keep humming. The labor market needs to remain robust so that consumers don't stop spending. Can all of those things mesh and make this a perfect, in quotes, scenario?
I mean, never say never, but at the same time, it does create difficulties for 2024. I think you're going to get bouts of it, and it's not going to be a straight path to those potential double-digit returns in 2024. I think the first half could be a little bit more murky as everybody anticipates these rate cuts, and if we don't get them and the economic data, it really does slow, and perhaps more so than everybody anticipates, then that bad news can really create some havoc in market.
Tom, how would you assess how I've described what needs to happen for you to be right? Am I overstating it? Or do things really need to be perfect for you to get to 5,200?
I mean, here's some simple math to think about. Earnings this year, $225. So we say 2 years, $265, so $40. 15 is going to come from just interest on the cash. So it's, 25 from organic growth, which is 10% over 2 years. It's basically GDP of 3%, real. I think that's pretty doable. So unless we have a recession, 265 is actually a low number. It could be 275, 280.
Wow.
For 2025.
In earnings.
In earnings, because remember, buybacks is another 5. I mean, just buybacks and cash is 10% a year.
275, 280 will make you you're so high up, we can barely see you. We need a telescope to see your number on earnings relative to where everybody else on the street is. I haven't heard anybody suggest, gosh, you could get high as 280.
I mean, just keep in mind, this year, healthcare earnings are down 20%. They won't be down 20% for 2 more years. And basic materials and energy are down like 40, and staples are down. So we could, as those turn, those contribute to S&P earnings meaningfully, especially energy, right? Energy was such a huge swing factor. It's been absent for this year.
Why is it going to be better next year?
Well, if let's say the price stabilizes, so you just look off the curve, they won't be dragging earnings. You'll actually have a positive contribution because they're not declining. So it's not hard to get to 265, actually. Sounds strange, but that's 2 years from now.
All right. Aya, financials, energy, do you like either in 2024?
We like energy. I think the setup for energy still remains very favorable. Valuations still aren't at extremes. I think, you've had some big announcements, in the industry that are consolidating. And, you have earnings growth. And if the economy really doesn't slow that much, if we get that mild recession or the, soft landing scenario, energy should continue to do well as we go into 2025 and beyond.
Joe, you wanted to take on Tom about his financials call. Why?
Financials and energy. First of all, with energy, what if the price doesn't go lower? It keeps, right? What if the price doesn't go higher, the price goes lower, you get a massive liquidation. Everyone is overweight energy, Tom. You know that. In addition, on financials, where's the earnings growth come from? Because if you think about it, you lose the effective interest income. Interest income was up 22% in 2022, is up 18% in 23. It's actually going to decline next year. JP Morgan and Citi told us yesterday at the Goldman Sachs conference that trading revenue's down. You've got all CEOs complaining about regulation in Basel III. What does that leave you with? Deal making?
Yeah, well, a couple things. One, what you've described is why no one owns financials, right? Because that's why hedge funds have the lowest long positions in 5 years. Second, as George Boyd, head of Kidder Research, famously says, it takes a whole lot of E to offset PE. The financials trade next year is about price to book or price to earnings, which means it doesn't matter what earnings do next year. It's how earnings power is transforming. And look, if we have lower interest rates, we know that this saves commercial real estate, it revives housing. I don't think any investor says, oh, well, your Q2 numbers aren't going to be great. They're going to say this is a switch in how we look at earnings power for the next couple of years. So I think financials have huge multiple expansion potential. And then trading, as you know, trading is spontaneous. It's weak this quarter. It could be huge next year. I mean, $240 billion taken out, gross exposure is low. I'm not surprised there hasn't been much trading. It's going to pick up a lot next year.
But in that scenario, you have to have a soft landing the way you're describing it.
I hope we don't have a landing. Yes.
I don't think Tom's suggesting anything other than that, if not no landing, right? I mean, if you think we can 270, 280 on earnings, well, we can't even come close to a soft landing. That better be a no landing, no late cycle, reacceleration of the economy for all the factors that you suggested.
Yeah, Scott. And one thing I think people have lost perspective on is when the Fed went on their tightening campaign and brought rates in the U.S. above any other developed world, we already had a hard landing in Europe and China. So the U.S. avoided a hard landing because what broke was outside the U.S. If you think those economies worsen next year, then we're in trouble. But if they're turning around and the DAX is telling you things are turning around in Europe, you don't need a landing in the U.S. because we had a landing elsewhere.
Aya, I give you the last word.
No, I think Tom always makes some great points about the market outlook, and betting against Tom has not been favorable, I think, to many investors. So I would go and listen to what Tom has to say.
All right, Aya, thank you. Tom, of course, thank you as well. Joe, we'll see you in the market zone because we have a little Broadcom to talk about.